Hey there, future billionaires and curious minds. Welcome back to the channel where we unravel the mysteries of money, success, and why your avocado toast costs so much. Today we're diving into something super weird, a financial phenomenon that's got economists scratching their heads and regular folks wondering if they're missing out on the next big thing. You know, back in the glorious year of 1996, the U.S. was practically throwing IPO parties, 739 of them. Companies were practically lining up to go public like it was the hottest club in town. Fast forward to last year, a measly 225. That's like going from a raging festival to a quiet Tuesday night at the library. And get this, some public companies are even getting taken private. It's like they're saying, nah, we're good, we prefer the secret handshake club. 30 years ago, over 8,000 publicly traded companies. Today, just chilling around 4,000. That's half. So what in the financial world is going on? Why are companies suddenly shy about going public? What does this mean for your potential investment portfolio? And why are those notoriously chill economists suddenly so worried? Well, grab your metaphorical popcorn because we're about to find out. First things first, why would a company even want to go public in the first place? Let's imagine you're a genius mechanic. Like seriously, you could probably fix a broken heart with a wrench and some WD-40. You start a company making ultra-fancy car seats for those ridiculously expensive luxury cars. Business is booming. You're practically swimming in, well, really comfy car seat money. But here's the kicker. In your spare time, you've secretly been designing a revolutionary new car engine. This isn't just any engine. This is an engine that runs on good vibes and slightly aggressive enthusiasm. Everyone will love it. The only problem? Building these bad boys is like trying to fund a small space program. We're talking raw materials, specialized machines that look like they belong in a sci-fi movie, more factory space than your average mall, and an army of new, super smart engineers. Your car seat money, while plentiful, just isn't that plentiful. So you hit up your richest friend, you know, the one who casually drops "my yacht" into conversation. You say, hey pal, I'll give you 10% of my brilliant car engine empire if you spot me the cash. Your friend, clearly a savvy investor and probably tired of hearing about car seats, agrees. Boom. Engines are flying off the shelves like free samples at Costco. You even land clients like Ford and Volkswagen. You're basically the Beyoncé of car engines. One day you're sipping your artisanal kombucha, admiring your engine factory, and you think, you know what? We're so good at engines, why stop there? Why not the drive shaft, the tires, the entire car? It's a brilliant, slightly insane idea. But even with all your engine money, building a whole car manufacturing plant and hiring hundreds of people is a bit out of budget. Even if you pooled all your rich friends together, they'd still be short a few billion. And probably arguing about whose yacht is bigger. This, my friends, is where the initial public offering, or IPO, swoops in like a superhero in a cape. So what is an IPO? Simply put, it's a company's grand debutante ball, its first sale of stock to us, the general public. Think of every company as a giant pizza. Each slice of that pizza is a share. In an IPO, the company basically says, hey, we're making a bunch of new slices, and we're selling them to anyone who wants a piece. This raises a huge pile of cash, but how do they figure out the price of these pizza slices? Well, they hire an underwriter, basically a financial fairy godparent, or highly paid banker, who helps them decide if they're ready, how much dough to raise, and a realistic price range. Now, selling more slices means everyone's existing slice gets a little thinner, but in exchange, the company gets a massive cash injection to build those fancy new car plants. The night before trading, the big institutional players, like those giant pension funds and mutual funds, get first dibs on buying shares at the IPO price. That money goes straight to the company. Then, the next morning, it's open season. Regular investors like you and me can buy and sell the stock. From that moment on, the company is basically living in a glass house. Quarterly results, analyst questions, dealing with the press, it's a full-time public performance. So why bother with all that drama? Well, the upside is huge. One, money, glorious money. Going public opens the floodgates to vast oceans of capital that just don't exist in private fundraising. New factories, product lines, groundbreaking research, buying up other businesses, you name it, they can fund it. 2, cha-ching for the early birds. Founders, early employees, and those initial rich friends finally get a clear path to turn their paper gains, i.e., this company could be worth $1 billion, into actual spendable cash. No more awkward conversations about whether their 10% of the car engine company can pay for a new roof. 3, trust me, I'm public. A public listing means audited numbers, regular disclosures, and a visible market price. This builds trust with customers, partners, and even potential new hires. Plus, they can use their stock as currency to buy other companies or reward top talent. Here, have some shares in our awesome company. 4, strength in numbers. Instead of relying on a few wealthy backers, the shareholder base spreads across thousands, even millions of investors. This makes the company more stable and less reliant on any one person's giant checkbook. No more my yacht debates influencing company decisions. So that's the classic story. A company starts small, gets big, needs more cash, goes public, and lives happily ever after on Wall Street. It's trading a bit of control and privacy for the resources and credibility to play in the big leagues. Back in the 80s and 90s, an IPO was the ultimate company milestone. You practically got a ticker tape parade. Today, the U.S. has fewer publicly traded companies than at any time since the 80s, and companies are waiting way longer to IPO, even the massively successful ones. It's like they're saying, we'll go public when we feel like it, maybe after our midlife crisis. A generation ago, any startup hitting $1 billion valuation was basically guaranteed to IPO. Not anymore. Uber, founded in 2009, hit over $60 billion before finally IPOing in 2019. A decade later, Airbnb, founded in 2008, had 100 million users by 2016, but didn't go public until 2020. 12 whole years. Some companies are just like, well, now we're good in the private club, thanks. Take Stripe, the payments company, founded in 2010, recently valued at over $100 billion. And as of 2025, they're basically like, IPO? What's an IPO? And then there's SpaceX. With a valuation over $400 billion, it's the world's most valuable private company. And Elon Musk? He famously said he won't even consider taking SpaceX public until they literally establish a working colony on Mars. So just a small, achievable goal before an IPO. We've also seen a massive rise in previously public companies being bought out and taken private. Remember Twitter? Poof, gone from the public markets. So why is the IPO seemingly going out of fashion like flip phones and dial-up internet? Well, it turns out there are 4 major reasons for this shift. And the more you look, the scarier things get, but also maybe a little interesting. Now, if you're watching this video, chances are you're the kind of brilliant go-getter who actually cares about wealth, success, and building a ridiculously awesome life for yourself. Let's get back to why companies are ghosting the public markets. Reason number 1, the rise of private money. Back in the 80s or 90s, if your tech startup needed, say, $100 million to fund its next growth spurt, you basically had 2 options, win the lottery or IPO. But in the last few decades, it's been a private money explosion. Venture capital firms are raising billions from wealthy investors. Private equity firms are raising even bigger funds to buy and grow companies without ever going public. Sovereign wealth funds, basically giant national piggy banks from places like Saudi Arabia and Norway, are pouring billions into private companies. And then there are hedge funds and private credit providers. In plain English, there are now colossal swimming pools of money floating around outside of the stock market. Today's founders don't need to go public. They can raise as much money as they need, often more, without ever ringing that bell on Wall Street. The result? companies are delaying their IPOs for years, sometimes indefinitely. In 1980, the average age of a company at IPO was just 6 years. By 2021, more like 11 years. They're twice as old and generally far larger when they finally decide to tie the knot with the public markets. Reason number 2, regulation and compliance. The bureaucracy monster. Remember the early 2000s? Corporate scandals like Enron and WorldCom, total financial dumpster fires. In response, Congress introduced a bunch of changes meant to restore trust. They forced CEOs and CFOs to personally vouch for their numbers and required companies to run internal audits. Good stuff for transparency, right? Yes, but it also made being a public company far more expensive. We're talking millions of dollars a year just to keep up with the paperwork, audits, and disclosures. You need a formal board, investor relations, and you have to disclose major events almost immediately. It's like living under a constant microscope. Some founders look at all that scrutiny and bureaucracy and just go, ugh, why bother? If private investors are practically throwing money at them, staying private is often the much simpler, less headache-inducing choice. Reason number 3, short-termism, the 90-day treadmill. Once you're a public company, you don't just answer to your customers or employees. Oh no, you answer to Wall Street, and Wall Street runs on a 90-day clock. Every quarter, you have to report your earnings. If you miss your targets by even a penny, your stock can tank faster than a lead balloon in a hurricane. If a CEO says something slightly negative on an earnings call, it can become front-page news, and billions can vanish from the share price in a single afternoon. Remember Netflix? They lost over 20% of their market value in one day just because they reported fewer subscribers than analysts expected. That kind of volatility is exhausting. It also pressures leadership to think in terms of the next 3 months instead of the next 3 or 30 years. Maybe you want to invest heavily in a risky new product that could be the next iPhone. But if that means missing this quarter's earnings, you might hold back. And it's not just earnings. Public companies also have to deal with activist investors, hedge funds that buy huge amounts of shares and then strong-arm management into making changes, like cutting costs or selling off parts of the company. It's like having a backseat driver with a megaphone. This is why many founders prefer to stay private. Going public puts you on that quarterly scrutiny treadmill, and once you step on, it's hard to step off. Staying private means you can be more patient, innovate without constant judgment, and build for the long haul. And finally, reason number 4, mergers and acquisitions. The big fish eating the little fish. This one doesn't get talked about as much, but it's a huge piece of the puzzle. A lot of companies that might have gone public in the past are simply getting bought out before they ever reach that stage. Especially in tech, the big guys, Google, Apple, Meta, have made a habit of scooping up promising startups, not just for their talent or tech, but to prevent rivals from rising up. Facebook, for example, famously tried to buy Snapchat in 2013 for $3 billion, partly to stop it from becoming a competitor. Snapchat said no, but Instagram said yes. Private equity firms also play a huge role, buying up companies that might have gone public, keeping them private, and then reselling them later for a tidy profit. For some startup founders, getting a big fat buyout offer from a bigger fish is the strategy from day one. Why bother with the IPO circus when you can get rich quietly? So for all these reasons, we're seeing fewer companies deciding to go public. But okay, who cares, right? Does this actually have any real impact on us? Well, it turns out yes, and it's a pretty big concern for some economists. You see, when companies stay private for longer, regular people miss out on the chance to invest in the early growth stages of a business, where the biggest gains often happen. Instead, those gains go almost entirely to private investors who were already wealthy to begin with. Over time, this could mean the stock market offers fewer high-growth opportunities for everyday people, and more of the wealth created by innovation gets concentrated in the hands of a smaller, already rich group. Not exactly a recipe for economic equality. And those pesky new regulations discouraging companies from going public, they exist for a reason. Regulations protect investors, keep consumers safe, and help prevent the kind of fraud and collapse that destroyed companies like Enron and wiped billions from the economy. When massive companies that affect millions of lives remain private, they don't face the same level of oversight. Their problems can stay hidden for longer, sometimes until it's too late. Just look at what happened with FTX and Sam Bankman-Fried. Total catastrophe that could have been mitigated with more oversight. And when it comes to mergers and acquisitions, look what just happened with Adobe and Figma. Adobe has a long history of buying up competitors and then basically killing their products to maintain dominance and charge ridiculous prices. In 2022, they tried to acquire Figma for $20 billion, but regulators stepped in and blocked the deal. Fast forward to today, Figma has gone public at a valuation higher than Adobe's offer. That means more value has been created, and now the two companies are competing head-to-head. More competition means more innovation for users. That's exactly the concern. When more and more companies get absorbed into giants, you end up with less competition, less innovation, and more power concentrated in just a few hands. That might be good for the Adobes of the world, but it leaves consumers with fewer real choices and potentially higher prices. So where does all this leave us? IPOs aren't extinct. They've just, evolved. The U.S. still has the deepest capital markets in the world, but companies are tapping into them differently. For decades, going public was how a company got big. Today, most companies only go public once they're already big, often massively so. On one hand, regular investors get fewer chances to ride that early growth wave. Companies face less scrutiny when they stay private, and entire industries risk becoming dominated by a handful of giants. Not exactly thrilling news for the average Joe or Jane trying to grow their wealth. But on the flip side, private markets have unlocked massive amounts of capital and given founders more freedom to grow on their own terms, without the constant pressure of quarterly earnings calls and activist investors breathing down their necks. It's a double-edged sword, folks. So our question for you, our amazing Investopians, is this. Is this a good thing or a bad thing? And what do you think happens next? Will IPOs make a comeback like scrunchies and fanny packs? Or are we just going to see fewer and fewer of them over time? We can't really predict the future, but what we do know is that the way companies grow and the way we invest in them is being rewritten right now. It's a fascinating, slightly alarming, and definitely hilarious time to be alive. All right, Investopians, thanks for spending some time with us today. Make sure to like this video if you found it insightful, and remember to subscribe so you don't miss out on our next deep dive into the weird and wonderful world of money. We'll see you back here next time. Until then, take care and keep those brains buzzing.